How's it going, guys? Hope you guys are doing well. Gonna be looking at how the dividend portfolio has been doing today. It's been about a month, I believe, maybe a month and a half since I last made an update video. Market has been going crazy. I've just been very busy. But, it's actually not looking too bad. We're kind of coming back. I think, we're probably not through the worst of it, but let's look at how we're doing. Before I get started, I do want to, make my normal disclaimer that none of this is financial advice, legal advice, or tax advice. I'm not a licensed professional in any of those. All this is just for entertainment. It's my 2 cents. So take it with a grain of salt and do your own research and consult a professional before you invest. Now, honestly, not doing too bad. I have the individualized results here, like we usually look at. I did add one new holding, which I'm going to talk about. And then I also have the totals pulled up here. If you guys remember, the total summary down here in Fidelity doesn't actually update with sales of stocks. It doesn't update with dividends. So it's really not accurate. It actually makes us look better than we are because the real result is a little bit lower, but I care about accuracy. So I have this spreadsheet that I've been putting in when I make deposits and transfers so that it can calculate both the non-weighted return as well as the time-weighted return, because I think both are interesting to look at, and one's a little more accurate than the other based on, the inflows of cash. So, I did miss 2 weeks in the beginning of October that I didn't make transfers in. I did double up last week to kind of try and make up for that, but I'm not super worried about that. I just wanted to try and keep it about the $20 a week that I've been adding, just so it's easy to keep track of and kind of see the progress over time. But at this point, I have invested a total of $1,100 in this account. And as you can see, the current value is currently at $944.37, which means that I've lost $155.63 currently. This represents a time-weighted return based on when I put in money and invested of negative 20.49% annualized, or a non-weighted return of about negative 14.15%. Neither of those is very shabby given the history of the market in the past year or so. Most likely underperforming because I have a lot of REITs and real estate investments in here, and those have been getting hit a little bit harder than the overall market, but the dividends still have been flowing. To date, we've received about $24.67 in dividends, which is pretty neat. A lot of the dividend payments are starting to get up above the $1 range, which is pretty cool to see. I've just been, buying into existing holdings aside from the one new one I added, which I will talk about. But you can see MPW and Armada Hoffler are the highest dividend payouts right now. IIPR also has a very high yield and it's catching up, but we haven't had that one quite as long. So let's look through here. Postal Realty Trust is the new one that I added. I'll talk about that at the end, but I just want to run through all the other ones real quick to get them out of the way. So the first one is Agree Realty. This is a retail REIT, like grocery anchored shopping centers, your Verizon stores, your AutoZones, your Home Depots, your IKEAs, etc. They own those buildings. We're about flat on them. They're actually the one we're least negative on in the portfolio. Invested about, I have it cut off actually. Current value though of my shares is $80. They pay a monthly dividend shares in our account too, because we've had them for a while. Honestly surprised with how well they've been holding up, given everyone, crying about how we're going to go into a recession and consumer spending is going to shrink, etc., etc. But pretty diversified business, and honestly, a lot of their holdings are kind of like consumer staples, like things that people aren't gonna stop going and buying. People are still gonna need Verizon, and people are still gonna go to Chipotle and AutoZone and Home Depot. Like, those things aren't changing. Let's skip this one for now. Blackstone, big asset manager, finance company, kind of a behemoth. This is a slightly more recent pickup. It's only down 2.5%. This has actually been having a strong past couple weeks, I believe, because it was down a lot more before. Got about $80 in them. Farmland Partners, they own, you guessed it, farmland. And by the way, if anyone's new to the channel, if you scroll back, I've made videos more specifically about each of these when I added to the portfolio. Kind of going through my logic for the pick and whatnot. But Farmland Partners, down 5.6%. Armada Hoffler, this is an old one. We've had this in portfolio for a long time, down 6.46%. This is a diversified REIT. They have multifamily, they have office, they have retail, they have construction segment. Honestly, holding up pretty well as well. American Tower, it's a cell tower REIT. They also have some data centers, down 8.5%. Most of these I've been trying to buy up equally. If some of them have been hit a little bit harder than others, so I've been buying more to kind of average my cost basis down. With that mainly being IIPR and MPW. But all of the rest of them, looks like aside from Zoetis and CPT right now, I have about $80, so pretty equally spread. Zoetis, this is an animal health company. They make pharmaceutical products for livestock as well as like companion animals. International company, 10.2% down on them. Equity Lifestyle Properties, they own some campgrounds, some manufactured housing / retirement communities, as well as some marinas. Pretty interesting business, down 11% on them right now. Postal Realty, down 13.3%. They own fulfillment warehouses. So think Amazon warehouses, that type of thing. Amazon is their biggest customer, I believe. They're very similar to Prologis, which I'm sure more of you are familiar with, as they're kind of a bigger player. Torreno's a little bit, or a decent amount smaller, and they're more concentrated in just the urban metro areas, which I kind of like. Innovative Industrial Properties, so this is a cannabis REIT. They lease out properties regarding both the cultivation and actual sale of cannabis products in states where it's legalized, mostly like limited license states, where it's a little more competitive and harder to get licenses approved to manufacture and sell cannabis. They've had some rocky news as of late. One of their tenants defaulted on some of their rent payments, and they were vacated from, I think, 2 of the properties that they were in, and the other 2, they're on some sort of agreement right now. I think it was, don't quote me on that, but that stock's been hit a lot. It's actually come back a bit, but down 16% on that one right now. The nice thing about that is, assuming, the business kind of steadies itself and turns around, which it seems like it's going to, as long as the economy doesn't get too worse. The yield is very high, so that's nice. Medical Properties Realty's trust. This is a hospital REIT, also been hit kind of hard. I think I made a video about this not too long ago, but there's a lot of concerns about the financial health of their tenants. And there's been some hit pieces about G&A expenses being a little out of hand. I don't fully know the details. I don't think any outsider can, but honestly, I think the risk reward is pretty good. The dividend is up at like 10% now because it's so low. I think people are overestimating how easy it is for these tenants to just be allowed to fail. A lot of these hospitals are in very key areas, and even if they did fail, another operator would likely step in and take over the lease to serve that community. So I'm not super worried about that, and as you can see, they're our biggest dividend payer thus far, down 21% on them. And then lastly, kind of a surprise to me that this one is this low, but I guess it's kind of just because I haven't bought into it as heavy as IIPR and MPW, which would probably be lower, is Camden Property Trust, which is a multifamily apartment REIT kind of centered around the Sunbelt region, down about 24%. I think a lot of this is just kind of pulled forward leasing demand and rent increases that we saw with the whole COVID transition. And now they're probably going to have to roll off on a lot of those growth numbers. And everyone's worried about, the economic downturn. So their pretty fancy apartments aren't necessarily going to be where people are spending their money. So there's some concern about that. Now, to look at Postal Realty. So from the name, you can probably guess that this has something to do with, post offices. And you would be right. So it's a very niche REIT. But they actually work specifically with the United States Postal Service. It's a smaller REIT. I believe its market cap is about a couple $100 million. And they own the actual buildings that USPS operates out of for, post offices. And if you think about it, I think it's a pretty defensive play. Most of these are viewed as, critical infrastructure. The United States kind of provides the USPS service as, I guess, what's the word I'm looking for? It's very, I don't know what word I'm thinking of. It's viewed as like a basic need that Americans are, have a right to and are entitled to as like taxpayers and just members of our community. So I don't even think it fully makes money, but it's just viewed as kind of a service that's provided, like roads and like public transit. Like, so I think it's not really something that would go anywhere. There are some concerns about, growth, government leases are usually flat lines, so they don't have rent increases, but that also provides some opportunities for, when leases roll over for big increases. And obviously the government is always going to pay, especially for these critical infrastructures. So if we look at it here, I've clicked around their site before. Let me see. I could just read through this for you guys. Postal Realty Trust is an internally managed real estate investment trust that owns and manages properties leased primarily to the United States Postal Service, ranging from last-mile post offices to larger industrial facilities. This is interesting. I guess they're set up as an umbrella partnership REIT. So the Realty Trust is just a holding company that owns operating partnership units. I kind of assume that this is how a lot of REITs like operated, where individual like facilities or locations, if they were big enough, had their own kind of like LLCs or operating units, and that the REIT just owned that. That may be a wrong assumption, I guess, if they're specifically calling this out. Maybe this is special, but that's the only thing that strikes me. since 2004, but they didn't go public until 2018, I believe. Oh, I'm sorry, 2019. So it's somewhat recent. Alright. Now, I do have their investor deck. This site is kind of cool though, because it allows you to kind of play around with like where they have different properties located. You can see Washington, pretty small holding. Oregon, small holding. They have about 4.3% of their properties in California. Nevada's pretty small. Idaho's pretty small. Montana's small. Wyoming small. Utah small. Arizona small. Colorado, actually decent holding in Colorado, about 3%. New Mexico, 0.4%. Same with North and South Dakota. Nebraska, 3% in Kansas. 2.3% in Oklahoma, 5.3% in Texas. That makes sense. Pretty big place. Minnesota 2.2, Iowa 1.6, Missouri 1.9, Arkansas 1.6, Louisiana 2.5, Wisconsin 7.3. That's actually the biggest so far. Michigan 3.3, Illinois 2.3, Mississippi 1.2, Alabama 3.5, Georgia 1.6, Florida 2.7, South Carolina 1.6, a lot of North Carolina 5.3, Tennessee 2.4, Kentucky about a half, Indiana 2%, now we did Michigan, Ohio 3%, West Virginia 1.4, Virginia 2.5, Maryland about 0.5%, Delaware pretty small, a lot in Pennsylvania 12.7%. It's huge. New York's 4.1, CT 1.3, Massachusetts 2.9, Rhode Island doesn't have any, Vermont 1, New Hampshire 0.4, and good old Maine 1.5%. Oh, we forgot Alaska. Nothing in Alaska. Oh, one property in Alaska. One property in Hawaii. And one in Puerto Rico. So you can see extremely diversified. And what's interesting to me is that like a lot of them are kind of in this Midwest area of the U.S., you know, where they're probably like smaller community properties that are serving, you know, smaller towns, probably not getting a huge amount of competition from places like UPS and FedEx, which I think only makes it more defensible. They've got some properties highlighted here. Let's see what they say for strategy. As e-commerce has grown, the USPS's unparalleled shipping and packaging services have proven to be vital across the logistics spectrum, including an unmatched ability to handle last-mile deliveries. USPS delivers to over 163 million unique points every day, except Sunday, and its approximately 35,000 facilities represent the largest retail and distribution network in the nation. No other organization can replicate the USPS's distribution capabilities, making its logistic network critical to the customers and the rapidly growing e-commerce industry in America. So this is like kind of the three types of properties they have. They have last mile, which is your typical like small post offices. They have flex, which is combination, so there's a front area with like a service windows and stuff, but then the back is a warehouse. And then there's just full industrial. They do have like huge insider ownership, which is kind of cool. Alright, let me pull up their presentation here. So, This is from their earnings call on November 1st, so it's about 2 weeks ago. So, Postal Realty's portfolio represents about 6% of all the leased USPS properties in the United States, so they don't really have huge market penetration, and it's honestly very fragmented, they say. With the next top 20 largest portfolio owners combining only owning 11% of the USPS postal building market, so it's super fragmented. A lot of room for growth there, so they're saying that there's about 286 million square feet that the USPS is currently leasing from landlords across the country. Of that, about 92 million is privately owned. Okay, so maybe they own a lot of this. 92 million is what they're leasing. 286 is what they're using. And then what's owned by Postal Realty is 5.2 million square feet. So there's another potential like 86.8 million square feet that they could potentially purchase to grow. Yeah, here it shows again. Here it's just broken down by the type, but you can see they're only owning like 5 to 6% of the USPS's total usage of leased properties. Most of their deal flow has been internally sourced. Okay. They're discussing how Amazon, UPS, FedEx, and DHL all use USPS. I don't know if sometimes you guys have noticed that either when you get a package or when you send it back, sometimes it's a UPS package, but it's like USPS last mile, and they get like handed off in between, so it's very intertwined. I think they're trying to say like, don't worry about Amazon, taking over USPS's business because they're still needed. 46% of the world's mail volume is processed and delivered by the USPS. That's insane. USPS has experienced compound annual packing and shipping revenue growth of 12.9% since 2016. That's actually very crazy. Stable credit tenant with consistently high retention, so about 98.9% of their leases are retained. USPS operating lease payments represented only 1.7% of the USPS's total operating expenses in fiscal year 2021. So they're just trying to say that like it's a very small expense for the government, but very crucial. It looks like actually to date this year, not a single person has not renewed their lease. That's kind of crazy. So the lease terms are most commonly 5 years. Yada yada. Yeah, so they're not subject to annual increases, but the lease term being pretty short versus like a lot of other real estate companies, the tenants they lease to, especially when they're industrial or government, they're a lot longer. So these frequent kind of renewals allow them to readjust the market rent. They're triple net leases, I think. So the tenant is responsible for the majority of the expenses increased. Yada yada yada. About a 6% dividend yield at the time of this presentation. 13 consecutive quarters of dividend growth. 100% of rent payments made on time. Very attractive. And they've been actively acquiring new properties. They talked about it on the earnings call. Since their IPO, all this has happened. Honestly, the dividend is the least impressive, but if they're just building out the portfolio, they're a pretty small REIT, so, they're probably focusing on other things. They own about 1,239 properties total in 49 states, 99.7% occupancy, and they also manage an additional 397 that they don't own. Pretty cool. A lot in the Midwest and Northeast and South, not much out West. which is interesting. I guess they're kind of based on the East Coast, though. You can see they get most of their money from the flex properties, and last mile industrial is the smallest segment. Since most of their stuff is kind of mom and pop or more rural ones, it makes sense that there wouldn't be a huge industrial property. Some cool Arizona ones. It's kind of neat. Yeah. Equity valuation at the time of this presentation was $373 million. Talking about leadership. 13% of outstanding equity interest in PSTL is owned by management and board. Diversity stuff, ESG. So, pretty cool. Let me know what you guys think of them. I honestly think it's a really neat pick. Definitely a little riskier